At the same time, the market is going to give you a lot of what we call supply zones. So for instance, let's look at this move here. I hope my screen is visible. So let's consider this movement here. You can see we have a number of demand zones around this zone here. So as a trader, how do you get to know the ones to choose, the ones not to choose, the ones to avoid? Yeah, there are many, there are many. You see, we have these also, we have these, we have these. So there are many. So number one thing, you first check for a demand or supply zone that is not mitigated. So never take a trade in a demand zone or a supply zone that is already mitigated. That is very dangerous. The rule is the hour news. In that, once a zone has been mitigated, the price is not going to respect it. So, uh, in that case, you have to be careful and know the role of mitigation and mitigation. So, when I use the term mitigated or a demand zone that has not been tested, they all mean the same. Testing and mitigation, they mean the same thing. Okay? So that's one way of now minimizing or reducing the number of reward zones that you have. The other thing is the strength of the demand zone or supply zone. The strength, the strength, the strength. How strong is the demand zone? How strong is the supply zone? So that's number one point. And how do you determine the strength of a supply or demand zone? Um, Point number one is how did the price leave the level? The how the price left the level. The how the price left the level. That's number one point. And I'm going to explain that. And please let's pay attention to this because it's very important because we are discussing on making entries in trading and you have to understand how to make these entries. That's why I've emphasized a lot on understanding how to draw the psychological zones, that is the demand and supply zone, or what we call order blocks. I've seen that you have shared some charts. We're going to discuss them. Now, please let's respond to each other kwa group. Let's respond to each other kwa group. Let's ask a question. Let's clarify. Let's mark for each other. So, CAT swali ukiulizwa it's directed to me. So let's be active. Let's interact in each other's chat. So number one thing is I've said number one, you just need to first check whether the supply zone or demand zone is mitigated. So for any mitigated supply or demand zone that is an X, it's not valid. Number two, I've said is how the strength of the zone. By the zone, I mean the strength of the supply or demand zone, depending on the market structure. And I've said there are many ways of knowing how strong the zone is, how strong the supply zone is, how strong is the demand zone. And I've said the number one point under this on knowing how strong the zone is how did the price leave the level. Okay? So like we said that our market, for a supply zone to be formed, we can have a rally base rally. So the how it left this zone here, the candlestick that it formed here, it dictates the strength of the zone, how the candlestick was formed. Was it candlestick yenye ilikuwa tu as in very small? Did the candlestick have wicks? Did it left the zone with a single candlestick ama there were multiple candlesticks? Okay, so the how it left the zone is dictated by the momentum. Like, let me just give examples here. Now take an example of this. Let's check at this zone here. Now this demand zone here is very strong. Number one, you see how it left the zone with huge candlesticks. Huge candlesticks. Yeah? Huge candlesticks. Huge candlesticks. So comparing this zone and this one here, the whatever, the supply zone here, which one is stronger? This one is stronger because you see this one left with the huge candlesticks. Huge candlesticks means like we have a lot of buys in there, a lot of buy orders that have been activated in that zone. But for this one, you see it left with candlestick with wicks. So these are weak zone. These are very weak zone. Like it's not that strong compared to this zone. Okay, same case. Let's compare this zone and this one, which is strong. Of course, this one. Why? You see, this one, yes, it left with a huge candlestick, but we have a very big wick here. And then let me remove this. You see, the wick came back. Then unaona utu candlesticks vile tuko very little dogo, like we meet. It means like there is indecision in that we have almost equal number of buyers and sellers in the market. So so the point on how the price left the zone is based on the type of candles, and that's why you see when the price came back to this zone, it will hold. You see, it will hold compared to, you see, when it came back to this zone, it did not hold. Why? Because this zone is weak compared to this. All right. Same case, we have this zone also. Yes, it left with huge candlestick, but you see these wicks. These weeks means like we have a fight between buyers and sellers. So it means like the strength of the zone is not that serious. So that's why unaona aftermarket ilikuja hapo ilibuy kidogo and then you can sell it, you got liquidated. Okay. So the nini the strength of a zone is dictated by the price, how the price left the zone, how the price left the demand zone hapa hivi. I'm sure you can check millions of examples. For instance, you see, let's check this one. You see this one here. How did the market leave this zone? You see, it left with very small candlesticks. You see, vile ni tudogo. That's why after the market came back to the zone, it did what? It just went, it react kidogo and then ikanini. So that's the concept there, how the market left the zone. Same case to this zone here. You see how this market is leaving this zone. This means yes, the market might hold, but this zone is not strong. It's not a strong zone. It's weak. So that tells you when you are taking an entry in such locations, you minimize the risk. But when you are taking an entry in such a location like this, you have a higher, you risk more as opposed to risking in these zones here. Okay. So yes, this zone might be the only valid one. So in such a case, you don't risk a lot because the market has a high possibility it's going to react, but it's not going to give you a good move. Okay. Point number two. I've said the first point is how did the price leave the zone. The other point is how much time the market spent on the zone. The 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 time the market spent on the zone. Now I'm going to explain that. Um, Let me check for a good example. A good one is this one here. You see, market spend a lot of time in this zone, around this zone here. Why? Because you can see before Ishuke EV, it spend a lot of time here. Spend a lot of time here. That means this zone is very weak. Okay, but for a market, for a zone to be strong, it means like market ilitap tu na ikaenda. A good example is this. You see at this point ya market haikukaa, ilikuja tu hivi na ikashuka chini. Okay, same case to hapa hivi. Market did not takes a lot of time, but let's look at this zone here. Let's take a look at this zone here. You see, market spent some time here. Spent some time here. So that's an indication of a weak zone. So comparing this zone and this one here, this means this is a stronger zone than this one. So the time that the market spent on the zone, it means the more time the market spent on the zone, the weaker the zone. Okay. All right. Let me use a higher time frame. Look at this zone here. See, the market spend a lot of time here as opposed to at this level here. So this tells you this zone is very strong as compared to this, and that's why this zone has been taken out easily. Same case. So you just compare the time the market is spending on the zone. Look at this zone here. Compare it to this one here. You see this is less time compared to this. So that's why market kukuja hapo ika respect. Okay? Aya. You see this zone here. Unaona hii time market imekaa hapa. The time the market is spending on a zone. This means these zones are very weak. They are weak. Okay? We're going to do much practice on this actually when it comes to making real entries, so that you will know what I mean. So assuming assuming that you wanted to take a buy from let's say from this zone here, because I'm assuming this zone, from the look of things, you see it's very strong zone. Why? Because you see the market how it left this zone. So I'm assuming now you believe this is a strong zone. But then after the market imekuja to the zone, let's say now market imetap into the zone, we anticipate that the market won't take much time in the zone. But if market does something like inakaa tu inapanda hivyo, that tells you the zone is being weakened, and there is a high likelihood that the zone is not, the buys are not going to hold up. Market is going to break past the zone. So if you've taken a trade at a zone, let's say you've taken a buy here and you realize the market is spending more time in that zone, it means that the zone is weak. Okay, it means that the zone is weak. The zone is weak, right? So same case, looking at this level here, you see the market has spent a lot of time here. So when market will be going up, we don't expect the market to hold at this zone. We expect it to just drop. In fact, most of successful trades, when they go to their zone of interest, they are not supposed to take long in such zones. Once they tap into the zone, they are supposed to bounce back. So yes, I hope you have an idea of what I have just explained. Let's move on. Now we are still on determining the strength of the zone. And the other way to know the strength of the zone is how far the market moved, how far the market moved from the zone before returning back to the zone. How far the market moved from the zone before returning back to the zone. What I mean by that statement is, let's say we have rally, base, rally. So the far it moved, remember after imenini hivi imeacha nini? Imeacha what we call demand zone here. So the expectation is it's going to come back to here so that you take a buy iendelee kupanda. So the distance it moved from this point here before coming back dictates the strength of that zone. If imefanya kitu kama hivi ikanini, but then ikapanda kadogo na ikarudi, it means this zone is very weak, as opposed to if imefanya something like this, then ikaenda for a longer distance, then ikarudi. It means that this zone is strong. Like if it has gone a longer distance from this zone before it came back to the zone. So if it goes for a longer distance, it means like this zone is very strong. So when it comes here, the trade that you're going to, the buy that you're going to take from this demand zone, it's going to be a low risk, as opposed to this one where it meant a very short distance like karudi. It means that the buy that you're going to take from this zone here, the risk, this is more risky than this. Is that point understood? Yes, so we're going to have practical examples on that, but I believe I can give one. Let me see whether nitapata moja.
Rudia kidogo, neti yangu iko na shida, so unaendaenda mbele sana.
Right. So I'm trying to see if I'll get a good example. Okay, I'll give an example later. On that one, I'm not getting a good example. I'm not getting a good example for that. Okay, let me give this one. You see this, we have a rally. We have a rally, then base, then a drop here. But you see it has the drop has not moved a longer distance from this zone. From this zone here. So that means this zone is not strong because the market after the rally base and then the drop is not long. So that means this zone is weak, and that's why umeona market after imekuja the same zone haijakupea good entry. Imefanya fanya hivi na ikapiga kilos, ika break to the upper side. So the how far the market moved from the zone after it dictates the strength of the zone. This is a perfect example of that. So zenye unapata ni rally base and rally kubwa, let's say a rally base then drop kubwa. So I'm trying to say zenye unapata, let's say this is rally, then we have a base, then a drop yenye at least is significant. So when the market comes back to this zone here, you expect it to hold vizuri adili kupea a break of structure huku chini. Okay, but in this case here imekuja base, then the drop here it's not that huge. So when market came back to this zone imefail kutupia break of structure, instead ika break to the juu. Okay, so that's a perfect example of where I'm explaining. I don't know whether we're going to get another one. No, this one is not a good one. But we're going to see more examples. I hope we're good in that point. Then the last point is the how many times the price is approaching the zone. How many times the price is approaching the zone. In other words, how fresh is the zone? How fresh is the zone? How fresh is the zone? So by that, let me explain. So you see, we have a rally, twist, then another rally. So market will come back there, sawa, and then you buy tena. So market ikikuja tena inamaanisha the zone is not so fresh, the market has come back there. So yes, itakuja hapo, but we don't expect it ipande sana, itaenda ikidecrease hivi, then itakumess hivi. So how fresh the zone is. So these demands on here, the first mitigation, yes, the market ilipanda vizuri, but now remember the thing is the orders that we are here have been filled by the first mitigation. So they come in again in Amansha, it's coming to take the orders that were not filled. So, and you remember the many orders were filled the first time. In fact, in other words, I'm trying to say the zone was initially mitigated. So the first touch, we expect the market to go far, to react very well. But the other touch, it becomes now very risky because the orders have been filled. So if the zone is so fresh, it means like the market is going to respect. In fact, wherever I know I'm going to get a good example from gold. When market tests a zone for several times, it usually takes it out. So let's take an example of this zone here. Now, this market is in a buy, like this. We have a higher low, higher high, higher low, higher high, higher low, and then higher high. So now these are break of structure here. So you're just looking for a good demand zone to take. And let's say like mostly for when it comes with experience, you realize for gold ina respecting sana the weeks, easy weeks. So tunachoranga demand zone yake hivi. Like this is the demand zone hapa hivi. Hiyo week ukienda to lower time frame it will be a good candlestick. So you see now when this market came back to this zone here this first time it respected na ikakuja ikatest tena. Now the second touch it means like the zone is being weakened. So the zone is getting weak. Then ikabounce then ikakuja tena. So it will be a risk for you after this last bounce ukichukua because the zone has been weakened. So now you are going to be taken out. The zone has been broken. So basically, in layman's time, I mean, if you are hitting on a wall, let's say you're using a hammer to hit on the wall. The first time it will be still strong. The second time it will start getting weakened, and the more you keep on hitting the wall, it's going to give in to that pressure. The more times you keep hitting on it, so that's the same thing that applies. The freshness of the zone, it dictates the strength of the zone. Okay, before you hit the wall, it is so fresh and it is able to resist pressure. But the more you keep hitting on it, the more it gives it weakens. So a demand zone that has been tested once, what I mean is the price has come back to that place once, it's strong. But after it has been tested once, it means if market comes back to that zone, it has become more weak. If it bounces and comes back to that zone, it has become more weak. So always avoid zones whereby price has come back to that zone more than at least once. If it has come back to that zone once, please avoid it, because the more the times the market is coming back to that same zone, the zone starts becoming weak. So that's the explanation behind that. Okay. Yes. So we have said the strength of a zone is dictated by those are they four factors. So for you to choose a demand zone, first you have to check if it is mitigated. Then you have to check how strong it is. How strong is the zone? So check whether the zone is strong enough. All right, let's move on. Now, that's one way of minimizing minimizing the number of the demand zones or the supply zones that you have in a area. Okay. Now, let me just cover them all so that we combine them together. So the other thing we're going to talk about a concept of Fibonacci tool, Fibonacci tool, and this is the Fib tool. This is the Fib tool here. This is the Fib tool. You place it on top, drag it down, then place it chini. So I know yenu ni tofauti. I want to help you adjust it. So let's open our computers. Let's take our Fib tool. Najua yenu itawaletea manamba mingi. I want to help you to customize it like this. Then I explain about it. Then we apply it. I show you how we apply it. So kila mtu.
Excuse Bob.
Yes.
Highlight your tool tena umeita fi.
In here hapa Fibonacci Fib retracement, this one here.
Okay.
I'm sure niliwaambia muiweke kwa tools zenu. It's there. Fib tool, you just when you pick it, click mara moja, then drag it, then click tena. No problem ukianza chini, like uchukue uanze chini na uinue juu hivi. Click. It's still very okay. So I want to see kama kila mtu amefanya hivi. Don't worry, itakuletea manamba mingi na marangi zenu mingi. So if you manage to do that, tell me so that I show you how to customize it. Use thumbs up so that we proceed. Done is done. Okay, carton is done. So tunangoja Victor na Barbara. Barbara.
Unaweza endelea na try kuhakisha laptop. Nita catch up.
All right, so the other thing, I know imewaletea a lot of numbers. Click the settings button hii hapa. Click here. Itakuletea something of like this. So you're going to uncheck. Sorry. When you click here itakuletea nini? You're going to uncheck zote. Then on your right, you're going to bakisha hii hapa. Ya kwanza isome 0, labda inasoma different number. Then uvuke mbili, hizi mbili uncheck. Check in yako hii moja ikuwe 1. Uweke 1. Then hii hapa roll ya pili uweke 0.5. Sawa. Just copy what I have here. Uncheck hizi ziko huku chini. The reason iko na mingi ni juu hizi ziko checked. Uncheck them. Kuna utu tu box, utu ndio tunatoa hivi. Utu. When you are done, sema. Kama uko na challenge useme pia. True. When we are done, mniambie. Cotton, Don. Victor, kwa sawa?
Swali langu ni unachora hii retracement wapi? Anywhere.
Yeah, anywhere.
So tumesema unaweka 0.5 na
Just copy hii niko hapa hivi. 0, 1 na 0.5. Hizi mbili tu. Tatu.
sawa.
Fib tool ni hapa. Hizi lines 4. Usichukue hizi za long na short. Hii hapa. Fibonacci tool. You drag like this. Then click the settings button and check easy. Okay. Then just check for 0. Labda iko na namba tofauti hapa. Unaweza change ikuwe 0, 1, then hii side ingine kukuwa na 0.5. Najua yenu labda iko na hii trend line hapa, unaweza uncheck this trend line iko hapa. Then for the percentages hapa kwa levels unaweza weka hizo percentages, unaweza weka percentage ama nini, but labels zikuwa on the right. Najua yenu labda iko kwa center katikati, but ziweke on the right. Zisonge huko katikati. On the right. Mm. Reverse. Iko sawa, iko sawa. Unaweza check ama uncheck. Nitawaambia mbona vice yote inaweza fanya. Kila mtu ako sawa? Okay, so now let me explain something. Najua rangi ifanani but rangi isiwasumbue. Rangi si kitu. Rangi haina shida. So ukichora hivi, ukipull from juu ama chini, ukipull from juu to chini, so zero iko chini. But ukipull vice versa, utapata nini iko hivi. So that's hiyo ndo reverse koto. Yeah. All right. Now, let me explain. Now, when you look at this thing, it got divided into two. It's divided into two. So the upper part, we call it the premium. This upper part, we call it premium. And the lower part, we call it discounted. So the upper part is premium, the lower part is discounted. Now, let me just ask a simple question. When you go to buy your jacket or your shoe, do you buy a price that is discounted or premium? Discounted. So this is the rule. Always buy at discounted price. So in the market, if you are looking to take buy from discounted price. I'm going to explain that. Same case, if you are selling, sell from premium price because you want to make maximum profit. I hope that is taken down. If you are selling, sell from premium. If you are buying, buy from discounted price. Simple. Now let me explain that. So what happens is if in this market moves in impulse, correction, impulse, correction, impulse. So impulse, correction, impulse, correction. So what you normally do is, you see this correction. Let's see markets. Let's look at the market from this point. Let me do something else. Let me delete. I show you. We have impulse. We have a correction. We have an impulse. So these are clear indication that this market is buying because we have break of structures to the up, like this. So now that tells you that we are about to get a correction. We are about to get a correction. If Cindy, like this one here. And now that tells you at some point here, remember this market you made a form some demand zones. Cindy, let's assume it's only demand zones market in a form. And you have applied the role of unmitigated zones. You may highlight demand zones and you see mitigated along this line. You have also highlighted a few of them zenye strong based on the principles zenye tumesoma. So the other thing that you're going to do is, since you're looking forward to take a buy, you're going to wait for price for this correction here. correction hapa, come to the discounted zone. Sawa? Because many buyers are willing to buy at discounted price. Sawa? So the moment you are trying to take a buy from this level here, okay, let me now. So for you to know that, you just pick your fib tool upper, then pull it from the lower, a higher low, add it to the higher high. Si market imekupea higher high up. Sawa? So you're waiting for market, sinaendelea kuretrace hivi, kusell hivi, it's correcting. So you're waiting for it to enter this zone. This is the discounted zone. So the moment market enter this discounted zone, now you check for the demand zones zenye ziko kwa discounted zone zenye zina match principles zenye tumesoma before. So that tells you usha cut off zenye ziko hapa, because they don't agree with the, because now if you take a buy from this point here, remember tumesema this is premium and this is discounted. So this is premium, this is discounted. So if you take a buy from this premium price, you will be the only buyer. In other words, you will be swimming against the big sharks, because the big sharks, they are waiting for a market to come to, so you will be selling against them. So you'll be the only buyer there. That means you'll be selling against them and you'll be taken out. Okay? At this premium point, in fact, most of the market players are selling. Na ikifika hapo now, they start looking for buys. So that's why nimesema you buy at discounted price, you sell at premium price, right? So you wait for market to get into the discounted zone. Once it gets into the discounted zone, you vet out the remaining demand zones zenye ziko valid. They have the qualities zenye tumesoma. It is unmitigated. It left the zone with good candlesticks zenye tumesoma hizo kubwa kubwa. The other one, the time that it is spent at the zone, like the rally based rally, take a lot of time, and at the same time make sure the zone ijakuwa tested, and then check the distance the market took from that zone. Okay, this one here. So you apply those principles so that you determine the exact demand. So if it is here, so now wait for market to come to that zone and then expect the market to do something like that. It may make sense. Yes, it's that simple. So that's how you like manage to do what? To vet out zones. So I'm just going to give an example because our time is gone. So now, which example do I use? So let's check at this price, the upper. This market here it's selling. So in a sell, this is where we have the breakout structure. So okay, then we have this, we have the breakout structure, then a correction like this, and then continues. So let's say umekuja kwa market and umepata market iko hapa, you are getting this correction and you have all these supply zones. So the first thing that you should do is just pull your fib from here like this. So no problem hata ukipull kutoka hapa hadi huku, it's still okay. Just know huku ni huku. So in this case, remember you are looking for a sell, so you are waiting for market to get into the premium. So premium ni hizo ni iko hapa juu. Okay, so you want the market to get into the premium zone. So that tells you around this zone, don't take any trade around E zone. So we just take a trade from E zone, okay, around this zone here. So now that shows you the only zone mebaki nayo ni hii hapa, then hapa juu. Sawa. So you have these two zones. Easy kwa hapa. So what you're supposed to do is set your sell limit here and then wait, see the market, because let me delete this. Now, this zone has all the qualities. You see how the market left the zone with some good, nice candlesticks. This supply zone has also given us a break of structure, right? It has met that quality. And at the same time, this zone is not mitigated yet. Remember, market sasa umeipata ikipanda hapa. Sawa, ijafika. So this zone has all the quality. So that's how you do it. Something else that I also need to emphasize, please, this what we are learning is not always 100% accurate. So usiniambie mbona imekuja hapa nimeenda past. No, it's a system to give you a higher win rate. So a system to give you a higher win rate. So don't expect always to find market book example kwa yenye umesoma kwa kitabu. It's exactly what you find in the market. Okay, let me give you another example. Now this market hapa imeshatupea change of character, then now imeanza kutupea break of structure to the up here like this. So this is a break of structure hapa. Then so now you're considering market from this point to this level. So you see the market umetupea several what? Several how do we call them? Demand zones. So in this case, we are looking forward to take a sell, right? So now that we are looking forward to take a sell, a buy, we are looking forward to buy from a discounted level. So you just pick your fib tool, you pull it up. So at any point price iko huku juu, don't ignore. So the moment imeingia hapa, you see the first supply zone here. So it respected the first one hapa. This was the first one and then ikapanda. Okay, now let's take an example. I hope imeleweka. I'm not moving so fast. Get good. Now I want to give you the last example. Now this market, now we are dealing with the market around this point here. So around this level here. So the first point, you just pick your fib tool like this. Hadi up. So anytime the market gets into this zone, you just wait for that zone. But look at this zone, it's already mitigated. So imekuwa mitigated, hii hapa imemitigatiwa na hii. So the first zone huku juu hii iko hapa hivi. This is the first zone, and you see the price touch new zone ikatupea some buy. So now the other zone remaining ni hapa. This one here, and that's why unaona market iko na kabai hapa. Kuna kabai kanye kanataka kuplay hapa. So as a trader who is purely based on technical analysis, sasa kuna mtu amechukua buy this USD card. But for me, I'm not gonna take this buy for, like, it's a good perfect buy, but there is an aspect of what I call fundamental analysis that I must combine. I must know the strength and weakness of the dollar. Hizo nitawafunza baadaye. So as for you now, based on your knowledge, what I have already taught you, at this point you're supposed to take a buy. Ifike hapo, watch it. So are we good? Yes, so that's how you vet out the zones and get the best zone. Imagine it's that simple. Mnaona vile ni rahisi? Yes, so tomorrow we are going to do many examples, but sijui kama kesho tutapatana. Let me communicate by ikifika 10 nione kama Cotton by 10 tutakuwa tumemaliza shughuli. Tutakuwa tushafika. Yes, so let's meet tomorrow. We work on examples. Then tomorrow I don't know if it's possible by kesho Cotton ukuwe umetuma hiyo video kwa nini, so that mrudie, so that tukinini kesho ibaki mtu amewatch tena. All right, so that's all right. Otherwise, have a good night. See you tomorrow. Bye bye.